Let's go ahead and start Chapter 2 using financial statements and budgets. So we're getting a little bit deeper into some of the financial planning material after just kind of talking about the basics back in Chapter 1. I'll let you read that on your own. I'll let you look at the learning goals on your own. This is what we'll cover in the chapter. Every chapter starts out with these facts or fantasies. You can kind of find them in the chapter and look at them on your own. Just some information here. Financial statements is really what this chapter is about. It's hard to that first point here. It's hard to get where you need to go if you don't know where you are. Right? I think just think of that like a map. Right? If I don't know where I'm at, how will I ever get to where I need to go? Kind of imagine yourself walking into a mall they've never been into before. You're trying to get to a certain store and you have no idea where you're at in the mall, right? You find a map. You figure out where am I now and where do I need to go, and you get there. So financial planning is a lot like a financial map. So financial statements tell you where you are today. Balance sheets describe your asset, liability, net worth. Income statements report how did you do over a certain period of time in terms of money in and money out. Did you add to your wealth or deduct from your wealth? We'll take a look at those. So I know that's kind of small writing right there, but basically the financial statements, kind of what they do for us in terms of financial planning. So financial plans, right? We talked about those in Chapter 1. Evaluate and plan major outlays, manage credit. Do we have insurance coverage that's adequate for us? Do we have savings? Are we being intentional about saving and investing our money? Are we taking the maximum benefit from our employee benefits where we work? Are we getting the right benefits for us? Are we going through legal ways to reduce our tax income using tax laws to our advantage? Are we using retirement programs available? Are we minimizing our estate taxes? Budgets monitor those, right? Budgets are monitoring our income, our expenses, our purchases, our savings. In financial statements, you can see as a back and forth between a budget and a financial statement. It shows actual results, a balance sheet and income and expense statement. So just like a business can do financial statements, so can a person. You can have personal financial statements. I know that's really tiny writing. You'll find the same information in the chapter, so you'll find it there too to look at it a little bit better view than what is on the screen. But you can see here we have a balance sheet from a personal level. So the various assets that we own, a lot of different types of cash investments that we have, stock and bond investments. Clearly, usually your primary residence would be the largest asset for a lot of people. Personal property, vehicles would typically be one of the larger components there of personal property. And then what you owe. If you have liabilities in terms of just any expenses that you need to pay for that you've incurred, bank loans quite often, typically a home mortgage, maybe a car loan, something like that. And then the difference between your asset and your liability then is your net worth. So you hear about what the net worth of an individual is. It's simply their assets minus liabilities equals your net worth. So a balance sheet just shows these items here. Just imagine what a balance sheet of a business would look like. And then also you can see that there's lots of categories here in terms of assets, investments, real property, personal property, different various levels of liabilities also. So net worth, again, I mentioned that already, just simply the fair market value of what you own. Your net worth is your assets at fair market value minus your liabilities. And so on a personal level, we go with fair market value. Now, a business wouldn't necessarily do that for all items. They might only go with fair market value for certain types of items. But on a personal level, we're really concerned more on a fair market value approach. Okay, so it's a little bit different. We're not following GAAP by any means. This is not something we don't worry about GAAP. We're just trying to figure out what are we worth based on the market value of the assets that we own minus the liabilities that we owe. Clearly, if we have a home mortgage, I want to find what the home value is, what it's worth today, minus that mortgage is the net worth of my home. Now you have to guess some of those things, right? What your home is worth is, what it's worth when you buy it, but if it's 5, 10, 15 years later, you're probably not exactly sure what it's worth. You can make a guess. You can try to find comparables. You can quite often maybe just have a realtor do a very simple appraisal for you, find some homes that are similar to yours that have sold recently, and do a comparison that way. You might have to pay for that. Some realtors might just do that for you as a favor, but there's ways to figure out what your assets are worth. Clearly a car, you can go to kellybluebook.com, find out what the value is. Antiques and collectibles are a little bit tougher sometimes, but you're just trying to get a fair value, an approximate value is good enough. Some liabilities clearly are current versus long-term. Current is payments due within 1 year or less. Long-term are payments due more than 1 year away. So solvent, you are solvent if your net worth is positive. You're insolvent if your net worth is negative. So there's just some examples here of some median net worths based on ages. Clearly you can see that it builds up the older you get, the higher it gets, and then once you begin to retirement, you begin to draw down those savings, and of course they typically go down then the older that you get. So income. Personal income statements are prepared on a cash basis. Remember, we're really not following GAAP with these. We're just trying to figure out what you're worth, and on the cash basis, we operate as individuals on the cash basis, right? So we're not worried about GAAP and accruals and all that kind of stuff, because just us as individuals, it's just for our information, for our basis. So cash basis is plenty, and your tax returns are prepared on a cash basis too, for the most part. So kind of makes sense you would do it from this perspective. So basically, a cash surplus is when you have more income than expense, so that increases your net worth. Income is money received. Typically, the biggest for most people would be wages, depending on what kind of job you have. Some combination of wage, salary, bonus, or commission. If you have investments, receiving interest and dividends on those investments, or as you sell investments, receiving proceeds from those. Those are all examples of income. Expenses, money you spend to live. We're all alive, therefore we're living and breathing. We need food, clothing, shelter, entertainment, various kinds of things. Your Netflix account, some people will say that's a mandatory thing I have to have. So we have to pay for those things. Those are expenses. So clearly, right, you want more income than expense to build your net worth on a monthly basis. So just examples of various levels of income and various types of expenses that you would typically see on a personal income statement. And again, this is kind of just based on government statistics that the author has found for us and put together. Just typically, what % of our expenses are various typically. Housing is 1/3 of our expenses. Food is pretty high, also at 13. Transportation, entertainment, healthcare, savings, cash contributions, everything else. So just give you an example of what those are. So if anybody's done GAAP balance sheets, GAAP income statements through the accounting principles classes, which not everybody's had at this point, I understand, but we do a lot of ratios in those classes. A lot of accounting classes, we just do ratios on financial statements. No different from this class with a personal balance sheet or a personal income statement. We can do some ratios. And if you are going to get a bank loan for a car loan, for a home loan, whatever that might be, a bank will probably ask you a lot of good questions about what's your income, how long have you worked at a certain place, what are your balances of your loans that you already have outstanding, if you've got credit card debt or a car loan already or a home loan, and they'll take that all into account and build some ratios for you. And they want your ratios to be within certain parameters, and that would probably some way give you a credit rating that they would then use to either give you a loan or not give you a loan, or that might use that information to base a certain interest rate that they'll charge you on a loan that you have. So just some other ratios, you can just take a look at those, just have kind of have a basic understanding. There's lots of information in the chapter about these also. But just know that banks like to look at these things if they're going to give you a loan. Okay, so budgets, a very important part of the chapter. Personally, I'm a big fan of Dave Ramsey. I would hope that many of you, being USF students, are familiar with Dave Ramsey. Most likely, many of you, your churches have offered Financial Peace University, I would highly recommend that you take part of that. Maybe your parents have or family members have. Um, so I strongly recommend, if you're going to get into budgeting, which you should, buy some of Dave's books. Financial Peace University, the training. He's got several paperbacks that are very inexpensive. You can buy them used on Amazon. Highly recommend you follow some of his training. They're very easy books to read. They will not take you long, but they will set you up for life. They just give you some really good information to help you with budgeting and help you make good decisions. Okay, so what a cash budget is just simply a forecast of how much cash you'll receive and what you think your expenses will be. Now, you can do this on a weekly, monthly, annual basis. You can do this for as long of a period as you would like. Dave Ramsey suggests you do this every single week. His suggestion was every Sunday night, do your cash budget for the week. Where's your money coming from? Where's your money going? Have an understanding and stick to the plan for the week. But you can do this for any time frame that you want to. Comparing your actual receipts and expenses versus your budget then helps you control. A difference between a budget and an actual is a variance. The variances can be positive or negative. Clearly you want some positive variances, but just always understanding your budget, understanding where your money is coming from and going, analyzing where you thought it was going to come from and go versus where it actually came from and went helps you get better at budgeting, helps you understand where your money's going, helps you make better decisions. So if you handle a budget deficit, so if you've got too much money going out versus the money coming in, you've got a couple of options, right? Either I got to make more money or I got to spend less, or a combination thereof, right? So potentially that means you have to liquidate some savings or investments or borrow money to cover a shortfall currently. But at some point you're going to have to say, what can I get by without? You know, if that's your cable bill, if that is your Netflix subscription, whatever that is, right? Are there things that I can just get by without? My daily trip to Starbucks, maybe I can do without that. Maybe I can make the coffee at home and get by. You know, those are all options to think about. Increasing your income. Do I take on a part-time job? You know, what are some things I can do to increase the money coming in, right? So that's, you know, whenever you have a shortfall, that's what you got to do. How do I cut my expenses? How do I increase my income? Time value of money, very important. Time value of money, I kind of alluded to it a little bit in Chapter 1, just in terms of you know, money invested now grows in value over time. As you invest, as you receive a certain interest rate, it will become larger. And so you got present value and you got future value. So $1 today is worth more than $1 received in the future. Relies on compounding, is when you're going forward in terms of making money worth more in the future. So future value is the value to which an amount today will grow if it earns a specific rate of interest. So the example here is, what will $1,000 be in 2 years if it earns 10% per year for 2 years? Clearly you can take 1,000 times 1.1 times 1.1 and get the answer. You can look up tables. There's present value, future value tables. The back of our book has one in Appendix A. Most of you will be using the ebook. You can find Appendix A in your ebook. Look at it there. You can use Excel to do these. You can use a calculator to do these. I am not getting into time value of money very hard in this class. The point is just to be aware of it. Maybe do some very simple calculations. But this is not the point of this class, is not to learn time value of money. I save that for higher level classes than this one. An annuity is just simply a fixed sum of money that occurs annually. You can have just any series of regular payments that happen annually. Okay, so that's what an annuity is. Just remember what that is, and it kind of shows you here how to do some annuity calculations also. And of course, there's several examples in the chapter for you. Another good thing to look at is the rule of 72. That basically, how long does it take to double my money? It says the number of years to double your money equals 72 divided by the annual compound interest rate. So, example here, if I have $1,000, how long will it take to double that if it earns 10%? So it takes 72 divided by 10, I get 7.2 years. So basically, I will double my money if I invested at 10%. Annually in 7.2 years. It will double or come very close to doubling, as they prove with the check calculation at the bottom there. Okay, so present value is the opposite of future value, clearly. the value today of an amount to be received in the future. It's an amount that you'd have to invest today at a given rate over a specific period of time to grow into a certain amount. So basically, it's typically, or here it says, the present value of 1,210 to be received in 2 years at 10% equals this calculation here, and you get $1,000, right? So basically, if somebody said you need to have 1,210 available in 2 years at 10, and if I set aside 1,000 today, it'll grow to 1,210 in 2 years. So Appendix D of your book has the tables to do that, and again, you can use Excel, you can use a financial calculator to do these also. It's more to be aware of these than anything else with this chapter. Then again, as you flip through the chapter, just some things I want you to be considering and thinking about. It's important to read the chapters. I'm very much just catching the highlights with these when I talk about the PowerPoints. It's important to read through the chapters too, but they go through and explain a lot of the components of the financial statements in just a little bit more detail than I did. And then they also give you an example of some balance sheets and income statements in the chapter to take a look at. And then they also show you a little bit about the ratios. Some of those exhibits that are light blue shaded, always make sure you take a look at those. They always have some really good information there. They also have a really good tips on budgeting section in the chapter that I want you to take a look at. It's very, very easy to read, that you'll find, I think, interesting, just in terms of just some good things to do if you're trying to do some budgeting. And then they talk about, towards the end of the chapter, they talk about the time value of money. And they give you several examples of how to do time value of money. And again, it's more important to be aware of that than to get into the nuts and bolts of it too deeply. The appendix in the back of your chapter has the tables that you can definitely use to help you do the time value of money quite easily. Okay, and then also I should point out at the end of every chapter there is always a list of key terms. Those are good to review. There's a quiz on every chapter, so those key terms would be good to take a look at. And of course, you're always going to be doing problems in Cengage at the end of every chapter too. So, but just take a look at the terms in terms of doing the quizzes also.